Hello, everyone. This is Steve Gorin, and thank you for attending today's webinar, Business Opportunities, Taxpayer Substance Over Form, Unincorporated Entity as S Corporation, all the items from my first quarter newsletter. Before we begin, we want to cover a few housekeeping items. If you have any questions during the webcast, you can submit them through the Q&A widget at the bottom of your screen. We will try to answer these during the webcast, but if a full answer is needed or run out of time, then I'll answer later via email. A copy of today's slides as well as other reference materials are available in the resource widget. And that other material is my first quarter 2021 newsletter, which has 3 different articles at the beginning, and those articles are basically supporting the slides I have here. You can find answers to some common technical issues located in the Help widget at the bottom of your screen. This webinar is CLE accredited in California and Illinois for 1.5 general credit, in Missouri for 1.8 general credit, and 1.5 general credit in Texas, which is pending. We will award CLE based on attendance for the entire 90 minutes. From time to time, you will be required to click a pop-up screen to reflect your continued engagement. The certification icon located at the bottom of the screen will only tell if you have met our criteria for awarding CLE. It does not include the certificate of attendance. Once we have verified your attendance, your certificate will be emailed to you later. This webinar is being recorded and will be available within 24 hours. You can access it from our website, www.thompsoncoburn.com. All in attendance will also receive a link to the recording. Please do not hesitate to share it with other professionals who may find it useful. And of course, if certain parts stand out, then they can fast forward the recording to those parts. We value your opinions and appreciate your participation in the course. Okay, so here we are on slide 2. So again, we'll talk about business opportunities, which will take a little bit more time than the other ones. And then we'll talk about taxpayer asserting substance over form, and also about unincorporated entity as an S corporation. So now on slide 3, for business opportunities, this has really been sharpened in some discussions. I'm in a kind of little study group that we email around, and every once in a while have a phone call. And people were talking about when you have a startup thing where the person is really just contributing services, and there's a lot of outside people who wind up in contributing capital, and you give your initial interest in this business to the family. You just count the initial capital contribution, or is there some additional value you have to count? And that really, we were having a discussion about that, and then I kind of thought, well, you know, I really ought to take some time at some point to go through this and look at some of the background on all of these issues. So we've got gifts of services and taxation of related employee benefits. So we're going to go through that. So when does simply rendering services wind up just being, okay, you're just doing a favor for somebody? Or when is it really tantamount to transferring property that would rise to the level of a gift? So we'll talk about that, talk about gifts of business opportunities, and then I'll talk about this recent development thing that we were discussing in this group. So now on to slide 4. So talk about the gifts of services and the taxation of related employee benefits. Now, of course, we are in this first article from my newsletter, and in my big PDF, which you can download from the newsletter. So those who are not familiar with that, in the newsletter, about halfway down, there's a couple of big yellow buttons, and one of them is the most current version of my business structure materials, which is over 2,800 pages long, and the other is a comparison against the prior quarter's version. So the parentheticals here at the top of the slide refer to parts of the big PDF. And you can always copy and paste from the slide, and in the PDF, you just execute a find function with the control F, as in find, and you can paste that cross-reference there, and then you can find where it is. And I definitely recommend searching using my full table of contents, and you can see the context for it. So we'll talk about gifts of services and the taxation of related employee benefits, and really the second kind of follows the first, and we're really focusing more on the first. Okay, so on slide 5, gift of services that generates a property transfer, taxation of related employee benefits, and what if you have a gift of services that's not accompanied by a property transfer? So on slide 6, there was a case called Dodge decades ago, maybe kind of going on even a century potentially, that said, basically the person said, I'm going to provide services, but you have to agree to give this property to my family members. And the court said, obviously your gift of services resulted in a transfer of property, so you're taxable on the income because you can't assign your income to somebody else. Whoever earns income has to be taxed on it. So you're taxed on that income, and then you've been considered to have been made a gift to whoever received that property. So I'm going through kind of 3 different levels of providing benefits here. In this first level, this first paradigm on slide 6, the employee or whoever is providing the service provider, they could be an independent contractor, et cetera, they bargain with the service recipient. And the employer or service recipient agrees to pay or otherwise transfer property rights to a third party. And again, that's the result, as I mentioned in the case, payment of compensation followed by a gift to the third party. Now on slide 7, in this case, on the first bullet point, employer provides the benefit. There hasn't been necessarily any bargaining going on. The employer simply says, okay, you're coming to work, here's your compensation, here's some benefits you get, and then the employee has the right to designate that recipient. That's this slide. The next slide we'll talk about where the employee doesn't designate. But in this slide, the employer provides a benefit, the employee designates a recipient. So here, by designating the recipient, the employee is exercising control over where that benefit goes. So that really is kind of comparable to the prior slide. I mean, the prior slide, the bargain element, and in this slide, it's not like there's a bargain, but the employee is still designating who is getting that property right. So with that element of control over who's getting it, we have the same type of situation. The benefit is compensation to the employee and a gift to the recipient. And I mentioned complete or incomplete. So let me do an example of life insurance. So there's a couple different life insurance benefits that might be offered. I mean, one might be, for example, group term life insurance. And generally, it's group term life insurance. The employee simply designates who the beneficiary is, if they do have that option. But again, on slide 7, we are assuming that they're designating. So the employee designates who would receive the death benefit, but the person who would receive death benefit actually doesn't have any right to anything because the employee could change the beneficiary at any time. So that group term life benefit would have tax consequences potentially to the employee. And then when there's a payment upon the employee's death, then that would be the transfer to the third party. But because it's revocable, it's an incomplete gift, there's no consequence relating to the third party's involvement while the employee is still alive in this group term life insurance idea. Now, sometimes people will irrevocably assign their group term beneficiary, and in that case, they've made a completed gift, and every year there is a benefit, there is a deemed taxable transfer to that third party when you've done an irrevocable designation of the beneficiary, because you've really given all your rights away. So similarly, split dollar, typically in split dollar, the employer is paying the premium. The employer is reimbursed for the premium out of any death benefit that gets paid, and then on the and then there's there's potentially cash to that policy, and sometimes you can have it where the employer owns it, but often you have it where, for example, an irrevocable life insurance trust created by the employee is the owner. So in that latter example, you have the irrevocable life insurance trust is the owner of the policy. So you have taxation of the benefit as compensation to the employee, and a transfer from the employee to that irrevocable life insurance trust every time that there's benefits provided under that split dollar arrangement. And there's a regulation directly on point that says about this compensation and deemed gift. So there's no gray area here in terms of whether that's a gift. Now, there's all different kinds of split dollars, so I'm not trying to go into all the variations. I was just trying to do the kind of simplest thing. And I have a whole section on split dollar for those who are interested in it. Most people, though, just roll their eyes when they see split dollar. They're like, I don't want to deal with all this complication. Okay, on slide 8. So here's a gift of services. So the employer provides a benefit where the employee cannot designate the recipient. The employee doesn't have any right to designate, nor did the employee ever have a right to designate. The employer just said, you go to work, and I'll provide a death benefit to your spouse, and you don't have any choice. It's going to your spouse, no matter how much you love your spouse or not. So in that case, that benefit might or might not have tax consequences. And in the DeMarco case, the taxpayer went to work from IBM, started when he was like, I think 29, maybe 27. I don't think he was married, certainly didn't have any kids, and he stayed with IBM for years and years and years. And then IBM provided a death benefit. And the tax court said, look, he's just going to work. He's not doing this to benefit anybody other than he's just going to work, and he's getting compensation for it. And he had no control over whether the death benefit was offered to him. He had no control over where the death benefit would get paid. He never did anything voluntary to make it be considered to be a transfer for gift tax purposes. Never exercised control over that situation. And this kind of harkens back to the idea of an act of independent significance. And you can see there's a parenthetical there in Roman numeral 3B, Romanet I, not Romanet I, I'm sorry, 3B, 1, and then I as a letter I in the alphabet. And this idea of an act of independent significance says, hey, whatever you're doing here, if taxes and the state tax is not really a motive. Instead, you're doing what you're doing because of the reasons for doing it, which have nothing to do with estate planning. So this doctrine of independent significance It can apply to employment. And again, you see there's kind of a continuum here for employment. Think about divorce, adoption, have significance just far in excess of any estate and gift tax consequence. Now, that's with a normal person, of course. I certainly have seen people who've done adoptions for estate planning purposes, and they've done it to abuse whatever arrangement was already in place. But yes, we have seen that happen. But the normal, ordinary, day-to-day living, you're getting a divorce because you don't get along with your spouse. You're adopting a kid because you want to be their parent and have parental rights with them. So, again, that's the normal thing, but I certainly do recognize that there are cases when you do have estate planning motivated things. You know, there is such a thing as an estate plan motivating divorce. Such thing as estate planning motivated marriage too. But this idea of the doctrine of independent significance, there's a whole bunch of authority in that area, and so this DeMarco case just kind of reminded me of that when estate planning is so incidental and there's no control going on here, then you can just disregard it. Okay, so now we have our continuum for services. Before I get into the gift tax issues, I just wanted to talk a moment about when you have compensatory property rights, some of the issues. You know, I already mentioned this assignment of income idea. Profits interests have been in the news. They call them, there's different versions of them. One of the versions is called the carried interest, where somebody else is putting on all the capital and you're providing services, but you get kind of an entrepreneurial return from it. And in the 2017 tax reform, they added Code Section 1061, which says that there's a 3-year holding period before you can receive long-term capital gain rates if you have something that's a profits interest and the underlying assets or business are things that Congress, you know, is kind of done in a way that Congress doesn't like. Another totally unrelated part to this, but it's still the idea of a profits interest, is that people will issue profits interest for the idea of, hey, if I'm the payer and I just don't get taxed on it, then I don't have to prove a deduction. I'm just shifting my profit onto that service provider. And as a service provider, when I get that allocation of profits, I might even be able to get some favorable treatment like capital gain or qualified dividend, which is tax with capital gain, you know, long-term capital gain. So I might get favorable treatment. So the question for profits interest is whether it really is entrepreneurial or not. And there's a set of proposed regulations that talks about whether it's entrepreneurial. So that is a whole long analysis that somebody might need to do. An area where it's particularly relevant in estate planning is when you have a family office that's managing investments. And under 2017 tax reform, investment expenses are not deductible. Even when they were deductible, they were subject to alternative minimum tax. Potentially, so they were still not that favorable. So rather than trying to deduct the payment, what if you can issue profits interest to the person providing the services, and then they can get paid? And particularly, if you issue your profits interest to a family office that's organized as a C corporation, there's a different standard for deductions for a C corporation. So the C corporation can deduct investment management fees, whereas an individual cannot. So then the question again is this more like just intended to be more like a fixed fee or fixed formula that's still going to get you something? I mean, it might go up or down a little bit, but it's still relatively fixed. Or do you have true entrepreneurial risk? If there's a loss for the year, then maybe you don't get paid at all, and maybe you even have to give something back. So that's what those rules are all about there. Disguised sale rules: if you contribute property to a partnership and you get a flow of cash back, is that a disguised sale? I mean, if it's coming out of operating income with entrepreneurial risk associated with it, then that's going to be respected as a contribution to a partnership. But if you have a pretty certain flow back and it's above what might look like interest, then any payments above that, what appears above what would have been interest, are considered to be a disguised sale. Slide 10. Now, from an estate tax viewpoint, if you have a profits interest, there's some issues that arise under Code Section 2701. Code Section 2701 is an anti-abuse provision. So, several decades ago, people would create these business entities, and they would retain the income and have the growth go to their kids, and then they would say, well, I'm going to get a return of X per year is what my estimated return is, and then it turned out that they didn't get that, and so all of this that they were supposed to, all of this that they said that they retained and they subtracted from their taxable gift was really just fake, according to the government, and so you need to have some fixed rights to get repaid, and really kind of where it again boils down to this is if you're having some kind of a capital shift to the family members, then or shift of profits to the family members, and you don't comply with the rules of the statute, you may have a much bigger gift than what you think. And I'm not going to get into all the different issues, and there's a lot of arguments over whether if it's just a pure profits interest, whether this provision even applies. So I'm not going to get into all those issues here. I just want to let you know, again, here's something that's kind of a compensatory nature of this profits interest, and there's some complicated estate and gift tax issues that go along with it. So these were both kind of a little bit of a sidebar, but I just wanted to put a little bit of flavor on it. So stock options. So again, the idea for a stock option, suppose stock is worth $20 a share now, and you say to an employee, you have the right to buy it for $20 a share sometime in the future. And so then when it's $30 a share, the employee exercises it and makes a $10 profit. So that $10 profit is really kind of a compensatory element then. So a lot of times stock options will say, well, the employee has that right, but only if he's still working there, or only if the employee has worked X number of years. You have to wait till they work that number of years until the employee can exercise the option. So you have a lot of times with stock options the idea that they're not vested yet. Vested means you don't have to perform any more services. You're just entitled to it absolutely. So non-vested means you have to perform services. So there's initially the IRS kind of recognized that when you have a stock option that gets issued, and the employee transfers it, that the employee's made a gift. But Revenue Ruling 9821 reversed the private letter ruling position inexplicably and said that the gift of a stock option is a completed gift until actually it should say is not a completed gift until the later of. So it's a completed gift on the later of these two things. So it's an incomplete gift until. So it's a completed gift on the later of the transfer, or when the employee's right to exercise the option, or in this case, the donee who received the option, is no longer conditioned on the performance of the services by the employee. So in other words, when it becomes vested, that is when it's the completed gift. That's what the revenue ruling says. Now, slide 12, I think the revenue ruling is wrong. In this case, stock options were transferred to a legally enforceable transaction in which the donor fully relinquished control. There are other revenue rulings that held that gifts were complete when the donors relinquished surrender rights became enforceable, and this is no different than those other rulings, in my view. So the employee or donor relinquished rights when they transfer the option, not when they perform the services. So, when the IRS is concerned about this whole thing on stock options, and I'm on slide 13 now, is that, well, if it's not exercisable, then, what's the value of the option? How can you even say it has a value? Because you don't know the employee's even going to ever have the right to exercise it or not. And the DeMarco case said, well, you know what? We don't care whether it's hard to value. Whenever you have a completed transfer, that's when you have your gift. And yeah, valuation can be hard, but what the heck? That's what we're all here for. We got to figure out the value. So I view this case as different than split dollar. So in split dollar, you have premiums that are being paid every year. And so if there's split dollar and the transferee is getting money added to their policy, premiums paid on their policy, they are receiving an actual transfer of property by the employer every year. So there's an actual transfer going on with split dollar. So there's an upfront transfer when you give the policy or the rights to the split dollar contract to the irrevocable life insurance trust. So there's a transfer then of the rights then, and then ongoing transfers every year when the employer makes those premium payments. Now that's different than this revenue ruling. In the revenue ruling, the employer is transferring the option up front. The employee is transferring the property up front. The employer issues the option. That's a one-time transaction by the employer issuing the option. Then the employee transfers the option. The employee is relinquished all rights. The employer is not making any future transfers under that option. The option exists. The contractual rights exist. The gift is complete then. I think that Revenue Ruling 98-21 is just plain old wrong. Now, if you're going to take a return filing position that's inconsistent with it, it would be a good idea to make a disclosure. I would even probably file a Form 8275 so that we can avoid penalties in case our court disagrees with us and decides the IRS is right. All right, now we're getting to gifts of business opportunities themselves. So first, there's I have a few different sections on loans and loan guarantees, family partnerships, and then I get into some more meat on it, sending business or performing services. And the first couple items, I'll let you look at those. I've talked about loans in other webinars. and a loan guarantee is not a gift, in my view. On slide 15, gifts of business opportunities. Well, Code Section 2501, the gift tax statute, taxes the transfer of property by gift. So when does what you do rise to the level of transferring property? So we saw in the employment context that if you did have property that got transferred from the employer or other service recipient to this third party, that there was a gift tax consequence then. But when do you have a property right that is being transferred? I mean, paying the life insurance premiums is a pretty obvious transfer. What about other cases? So in Crowley, my dad owned the bank, and the bank entered into a partnership with his kids to handle appraisal fees, insurance fees, and title commissions. So the bank was loaning money, but when you have a loan, you have all these other things that occur. You need to have appraisals to verify that your collateral is adequate. You often have credit life insurance, so that the loan gets paid back if the borrower dies, and title insurance to make sure that there's good title to whatever property is being transferred, particularly real estate. So here, the bank made a partnership with the kids, and for example, the son did appraisals, and he could not have attained appraisal work if dad hadn't caused the bank to refer the clients to him. So the bank would go make loans, and the bank would say to the borrowers, hey, borrower, why don't you go get an appraisal from son? And without having gotten that just oral, informal referral, the son wouldn't have gotten that appraisal work. But who did the work? The son actually did the work. The appraisal is what generated the fee. Yeah, the son would not have had the opportunity to do the work if he hadn't gotten the referral, but the son himself did the work. The income was taxable to the partnership, not to dad, and there was no gift. Slide 16. Here's another one. Brother directed business to suppliers for whom his sister was a broker, and the brother's corporation was, really how the brother was doing business through the corporation. But again, the sister had to do the work of brokering the sales. It was real work that she had to engage in. And so again, the tax court here held that the brother was not taxable on that. The sister did the work; she earned it, so everything was taxable to her. There was no gift going on. And here, I don't think it was really a gift tax case. It was more of an income tax case. But again, the income was earned by the sister. Okay, slide 17, we have a more recent case, Bross Trucking. In fact, I know the lawyers in St. Louis who litigated this case. And in this case, there was a trucking business, and the trucking business got into regulatory trouble. And so the owners said, kids, you go start a new trucking business, and you can do the work. And his sons did develop a relationship with the customers. So basically, dad shut down the business, but during the course of the business, the kids had gotten to know the customer some, and then when the kids started their new company, they said, hey, come over here. Dad had to shut his doors, but come over here. We're a pristine business. We're fine to do, to work with. And a key here is that they didn't have a non-compete agreement. So the kids did not have a non-compete agreement, nor did dad. So when the relationships went over to the new business, there was no property right that got transferred. So a non-compete agreement can be a valuable property right, and so and it's kind of tough to distinguish between non-compete and goodwill. And so if there is not a contractual or other legal right to the customers, then moving the customer somewhere else is not a transfer of property, is the idea here. And there was another state, there's another case, and they all kind of come in, all around together. Again, another case, the Adele, where the lack of non-compete precluded corporate goodwill. So, again, another case where the goodwill, the business went to a new entity and there was no tax consequence. Practical estate planning applications. If you're expanding business into a new location, if you have new branches and a new entity, maybe the kids can own the new entity. Maybe they might borrow money from the company, but the company is not selling them the operations. Rather, they are they're just simply saying, here, you can do the business out of your company, out of your brand new company. So the companies, the kids might start a new business entity, and then the company would borrow money. The operating company would loan money to the new company. But again, it's not a sale of anything. It's simply borrowing money so you can get your startup going. Real estate leasing is another thing. A great case in point is Walmart. They would go into areas and build a store there. And what they would do is the owner would go and tell his sons-in-law, here, I want to have a store here, and the son-in-law would buy the land at dirt cheap in the rural area, and then he'd go to build a building on it, and he would basically be presented with Walmart with a lease. It says, okay, here's a long-term lease. I'm going to rent this from you. And Walmart is good as gold. I will loan you on, based on that lease, I will loan you the money to build your building. So really there's a corporate opportunity, the benefit of buying land for cheaply and then putting it to productive use, and also the use of the building. That really is a corporate opportunity that wound up being used for the benefit of the sons-in-law. But again, there wasn't like a legal right that got transferred. It's simply, if you build it and I will come, is the idea. So that there's no gift tax consequence of that. Now, it takes a long time to build up equity in real estate, so a lot of people are really not troubled by that. We'll talk in a minute about a different situation. Another opportunity might be equipment leasing. There's equipment being done in the business, or maybe the kids buy the equipment and lease it, and they make a profit between the paying the bank on the equipment loan versus the rent payments they get from the business. And kind of even not quite the same example, but client who died several years ago had a business where he would develop a relationship with a user of very long-lived personal property. And what he would do is he would go to the banks and borrow money to buy the property, and he would, buy that property and then lease it on the long-term lease to the user. And then after a while, he's like, I have enough money. I want my kids to be able to have this opportunity. So he would go and arrange a loan with the bank and arrange the lease with the end user. But yet it was the kid's entity that owned that property, the kid's entity that was the borrower, the kid's entity that was the owner of the property, the kid's entity that received the lease payments. So that was not a transfer by him. There was no property transferred. He simply facilitated the business opportunity. He also did that for one of his employees too, as a way just to thank them. He got them set up with their own entity to do that. Now, here's what's coming with capital markets, and in particular, this is a special purpose acquisition company, or SPAC, and what they do is you get a few people who are kind of the promoters, and they go and do a little public offering and raise money, and within 2 years they have to spend that money to buy a business. And they do have to put in money to begin with into the business before they go out and raise the money for the public. They need to contribute money because it costs money to do to get the all the circulars and stuff for the public offering, to get it approved by the SEC. You have to do all the stuff before you can get the outside money in. So it requires money up front to do all that work, and pay the lawyers to do it, et cetera. And certainly that's a very worthy activity, paying lawyers. So anyway, so they go. So there is a required investment to begin with. Well, what if your irrevocable trust or your child invests the money in this SPAC up front? So the SPAC has the money to be able to use to go and do the work that's required in order to qualify to do the public offering. So some people think, well, the only reason that there's value there is because of the personal services that are being done. The irrevocable trust would never have had that opportunity if the donor hadn't been performing those services. So some people feel that that the donor who performs the services is actually giving away something that's much, much more valuable. Even if the money comes from the irrevocable trust to begin with, to help finance all the paperwork that's being done to qualify for the public offering. There's some people who believe, well, you still just have an inherent value because you're promising to do the work. But my view is that money is needed before you can do the public offering, and the services are being done voluntarily by the donor. The donor has reputational risk if they don't do the services, but it's still voluntary by them, and they didn't say, they did give the business opportunity, to that trust to invest, but that trust has that property whether they perform the services or not. Now the services will go nowhere. The property will go nowhere in value if they don't perform the services, but it's still, they're doing the services, voluntarily. So anyway, so my view is that, if they give away their interest in the SPAC, after you've already qualified it for the public offering, well, then you have some issues going on there. But if up front is simply giving the opportunity to invest in this deal, I don't view that as being a gift. But again, some people will disagree with me on that. So it's up to you to exercise your judgment as to where you come out on this. Okay, so again, slide 21 here are some of my, the arguments that are going on, and and why I believe it's not a gift. Okay, so that's all to this area here. Let's go on and talk about substance over form issues. When a taxpayer may disavow the form, practical applications for disavowing the form, and tax issues on business formation. And really the third thing is not as much related to the first thing, but it's the case generated, the substance over form case was a business formation thing, so I thought I'd just kind of throw in some ideas that go along with that. So here's the case. Complex Media, 2021 Tax Court Memo. It's funny, some people like to say tax court memo aren't really precedent, but here we have one that goes through the entire history of substance over form arguments. So, it really is very, very instructive. So, the Complex Media case hails back to a case called Danielson, and the court says that we examine the substance. We are not bound by its form. Now, that's the judge saying the court is not bound by the form. And of course, we know that the substance ultimately controls, but we also know that if a taxpayer chooses the form, they might get stuck with it. So what are the rules for that? When is the taxpayer stuck by the form and when is the taxpayer not? On slide 25, the court recognizes that even though normally we view this as something that only the IRS can use, that the taxpayer cannot disavow the form, that's not really true. Taxpayers can use it. It's just on slide 26, we kind of go in terms of what's burden of proof. And the court points out that, look, the IRS is dealt a set of facts, and they don't like the set of facts, and they think the substance should control over the form, then let them have at it with the argument. Now, a taxpayer gets to choose at the beginning what the form is. So the taxpayer is kind of in the driver's seat with that form. And on slide 27, there needs to be a higher burden faced by the taxpayer to disavow the form because taxpayers set it up, so they're talking out of both sides of their mouth. They want to do something other than what they've set up. Now, what is the rule? It's more than a preponderance of the evidence. On slide 28 says the taxpayer has a particularly high threshold in seeking to disavow the form. On slide 29, there's a pretty long quote there, but the question is, how do the taxpayers treat the transaction? Are they just kind of wanting to disrespect everything that they did and just make an argument here? Or is there something else going on here? And they're concerned that the IRS can be whipsawed if one party says, hey, here's what the transaction was, I get these tax benefits under this transaction. And the party on the opposite side says, well, yeah, there's detriments to me of this transaction from a tax purpose, but I want to disavow those, so I want to get the benefits too. So instead of having a trade-off with one side getting benefits and the other having a tax disadvantage, the IRS can be whipsawed where both sides say that they have tax advantages. On slide 30, so again, in this particular case, the taxpayer wanted a stay-step transaction, but they didn't meet the strong proof test. And they said in particular, look, you even thought about the substance here. You chose not to structure it that way. Because you affirmatively chose not to structure it that way, we won't let you later on choose to report it the way that you rejected as a form. So they did mention, now this slide 31 relates back to slide 30. In that prior case, that the taxpayer hadn't met the strong proof requirement. So in slide 32 is our summary here, which says that a taxpayer can argue form over substance, but they have a higher burden. And they didn't say exactly what that higher burden is, but it's more than just preponderance of the evidence. Slide 33, the taxpayer has to show that the form of the transaction was not chosen for the purpose of tax benefits that are inconsistent with those the taxpayer wants by disregarding the form. So you chose the transaction for a particular reason that was unrelated to the tax benefits that you want to get now. It's not like you had a trade-off of tax issues going on with you, taxpayer. You had a particular reason other than what you're trying to get as a benefit now. Now, where are some practical applications of this argument? If you have a sale or exchange of intellectual property, if you sell your patent, you could get capital gains. But if you're just doing an assignment, like if you're doing like a lease of your patent, then you're getting, royalties from that, which are not capital gains. So there's some substance over form that goes on there. There's a sale of a business, whether it's a non-compete or a sale of goodwill. Income you receive from a non-compete agreement is ordinary income, whereas the sale of goodwill is generally a capital gain, unless you would amortize that goodwill. There's also some cases, Code Section 754 election. Actually, there was a case where the IRS applied 2036 to a partnership and said, we're going to disregard the partnership. And the tax court said, fine, we're disregarding the partnership. The taxpayers have to pay a state tax, but the assets that were included directly in the taxpayer's estate also got a basis step up at death. And you didn't have to make a 754 election for that. And that was the Hereford case, Hurford. Now, on the other hand, there was a taxpayer who wanted to invoke Code Section 2036 and said, hey, I had a bad partnership. I want to have a state inclusion. And the IRS was like, nope, you chose to have that partnership, and we're not going to let you get the state inclusion on those assets. And, the benefit of disregarding the partnership would be that there's no valuation discount. So let's suppose you do a partnership, and so ordinarily there might be a valuation discount. Sometimes it's argued it might be as low as 10% or so if it's a marketable securities partnership. But if it's if it's real estate, that tends to be more like 40%. The wholesale business might be as much as 50% for lack of control, lack of marketability. These are all just very, very round numbers. I'm not trying to say this is what you should expect, et cetera. It's up to your appraiser to decide that. But the idea is that there's some rather substantial valuation discounts that apply by having assets inside a partnership or other business entity. And yes, those can save estate tax, but what if you don't need to save estate tax? What if the estate tax exemption has increased to be above your estate? Or what if your estate has gone down in value so that you're below the threshold? In that case, valuation discounts might not be helpful at all, and they simply mean that you have a lower basis. So maybe you want to disregard the partnership to get a higher basis. So you have to have a pretty strong proof to be able to invoke 2036 as a taxpayer. So again, in the Hereford case, the IRS invoked 2036, and then the taxpayer said, well, if I'm going to get the detriment, then I also get the benefit. But in this other thing that I cite in my materials, the taxpayer said, yeah, I had a partnership, but I just want to get my basis stepped up. All right, on to slide 35, tax issues and business formation, which this is where this complex media came from. So there's an idea, normally when you form a corporation, it's going to be income tax free, but if you receive some cash back, then you can have gain, and that's called boot. That cash is called boot. And in the complex media case, there was a very significant amount of boot. And the taxpayer invoked substance over form and step transaction to allocate basis of the assets that were received. And the taxpayer didn't follow the right procedure, but the court did allow the basis to step up on the boot, and then the taxpayer was trying to figure out, well, how do we allocate, where does this boot get allocated? Yes, there was gain on the sale, but in terms of the assets that were deemed sold, which assets received how much of this boot so we can give them basis and depreciate or amortize or write them off as inventory, whatever else. So I'm not going to go through all the details here, but a lot of times you do have transactions that might involve boot or might involve some just kind of an allocation of gain because it's a taxable transaction. And this case kind of goes through what the tax court was persuaded by in figuring out how much should be allocated. And here the taxpayer hadn't used, there's a particular procedure that the IRS had promulgated, and so the taxpayer had a really high burden here. So you'll be able to see what the taxpayer was able to prove, and the taxpayer really didn't get disadvantaged all that much for not having followed the proper procedure, because the basis had to go somewhere. Okay, on slide 37, normally when you form a corporation, the Code Section 351 says if you transfer assets and get stock back, then it's a tax-free incorporation. But what if you already own the stock and you're just putting more money into the company? So there was a 2020 memorandum by the IRS that it's an internal memorandum, but it's released under the Public Freedom of Information Act. And this internal memorandum says, that if the taxpayer already owns the stock, they don't need to be issued stock. I mean, issuing them more stock, it would be just kind of silly. If they already own all the stock anyway, why do you issue them more? Just put the money in, you've got your tax-free contribution to capital. There was another case where there's a government incentive that went to a business, was that a contribution to capital that was tax-free, and the answer in that case was no. I'm not going to go through all the details here because I'm kind of running a little bit behind. So I'm going to go on to this next one about diversification of investment risk. And this, again, is the same type of thing if you form a business entity and you have this tax-free contribution of property to the business, are changing your economic position by putting that property in there. And one thing that Congress wanted to do is, yes, you can change your position because we're all pulling our assets together to start a business, and by investing in this business, we're going to, all profit from it. But what if you have something that's more like a holding company? And A puts in Apple stock, and B puts in Pfizer stock. Those are different industries. And C puts in maybe General Motors stock. So those are all different industries, and often they move in different directions. Sometimes they move in the same direction, but there's a diversification going on in that case. So Congress didn't want you to just pool your assets for the sake of getting diversification, and they basically said that if your pooling of assets constituted diversification, then we're going to tax you on it. Now, there are some ways to pool your assets where you don't get hit for having diversification. One of those is maybe you retain the risk for a long enough period of time, and the answer is 7 years. If you retain the risk for 7 years, and then after that you have your interest in the other asset, then you're going to be okay. But that's a long time to retain that risk. So anyway, there was a 2020 letter ruling that where somebody had contributed an investment into a partnership, and the tax court said you need to look to see, if you're contributing, old business to the new business, what does the old business have? Is the old business itself the security you're looking at when you look at diversification, or do you look at what the old business has? And if the old business has, for example, a diversified portfolio, then you're going to look at the fact that was already diversified. Instead of considering the old business a single entity, you would look at what it's invested in. Now, this rule on tax reformation is usually thought in terms of when you form a partnership. The statute was actually based on a corporate statute, but what happened is the Tax Reform Act of '86 said, well, you can't liquidate your corporation is tax-free anymore. The only place you can really do that is in the partnership area. Again, I'm overgeneralizing. I'm not trying to say what the law is for everything, but as a general idea, you can't liquidate your corporation tax-free, but you can liquidate your partnership tax-free. So now the partnership is where people are trying to go and diversify. So the partnership rules are based on the corporate rules. The statute and regulations are under the corporate tax rules, but all the cases you see nowadays are generally going to be partnership cases. Okay, so gotten through the first two segments. Now I'm going to go on to my third topic, which is unincorporated entities making an S election or owning S stock. So I'm going to talk about that particular issue. I'm going to get into a little bit of recent developments, but one of the things that I mean, besides the income tax issues that concern me about having an LLC or a limited partnership make an S election, besides those issues, I also want to talk about, well, what happens with Code Section 2036? Because we've had this whole string of cases, and ending in 2036 cases, ending, which include Powell and Moore, whatever. I mean, there's a nuclear remedy here with 2036, and it really ups the stake to whether the 2036 applies or not. And I'm going to go through how being an S corporation might be favorable from that 2036 argument, and then what happens when you have an unincorporated entity. So, slide 41. First, let's get into the income tax issue. and talk about how the single class of stock rule affects an LLC or a partnership qualifying to make the election. Then we'll talk about estate planning issues unique to S-Corps, and then how these ideas interact. So on slide 42, an LLC can elect taxation as an S-Corp simply by filing the normal S election. So you don't have to have a separate entity to say, a separate election that says the LLC is taxed as a corporation, and then you do your S election after that. The LLC can just straight on directly make the S election on Form 2553. And if I am going to do an unincorporated, if I am going to have an LLC do that, I would rather just file that Form 2553, so that if the S election is somehow invalid, you're going to revert back to a pass-through entity. If you did Form 8832 to elect taxation as a corporation first, and then you made your S election, and then you blew it, then blowing the S election would have the consequence of having you be stuck in a C Corp, which, following a piece by Sam Donaldson, he called C corporations roach motels. They're easy to get in, but hard to get out of. When I told him I'd attribute that comment to him in future speeches, he said, well, he didn't make that up himself. But I heard it from him, so I'm going to give him credit anyway. All right, slide 43. So every unit of ownership has to have identical rights to distributions and liquidation proceeds. That's the single class of stock rule for S corporations. Now, if you have an LLC or a partnership, those agreements typically will talk about maintaining capital accounts and having special allocations of income. The partnership income tax rules are very complicated. And even if you intend to have a pro rata allocation of income, there are things like who's liable on the debt, who's guaranteed the loans. There are also if you've contributed appreciated property. There are a lot of rules in there that are not really strictly pro rata. Even if you want to be pro rata, the income tax rules don't let you be strictly pro rata. So we have all kinds of provisions in LLC operating agreements and partnership agreements that are geared toward these tax rules. Now, if you make an S election, then you need to be concerned about these provisions that are non-pro rata. You need to strip out those partnership tax provisions and put in S corporation protections. So you always need to do that. And there are countless letter rulings where taxpayers did not do that, and they had to go and get inadvertent termination relief. Now, what if you have an entity that's taxed as a partnership, like an LLC or a state law limited partnership or something else, and you have non-prorated capital accounts? Just because you've had disproportionate distributions, disproportionate allocations of income, et cetera. And now you want to make an S election. What you need to do is to equalize the capital accounts and make up for those differences by issuing a note. So if taxpayer A had a disproportionately high capital account by $1 million, then you issue a note of $1 million to taxpayer A and consider that to be a distribution to capital A, to partner A of that capital account. And I mean, if they were already entitled to it, they probably already have basis in it. There's going to be no consequence to that. But you go ahead and convert that to a note. So you always need to stress test before doing a conversion of an existing LLC or partnership into an S Corp. Stress test those capital accounts and make sure that you've equalized them and issue notes accordingly. Now, a lot of times people have employment agreements or other side agreements. And if you're in the corporate arena, those agreements generally do not violate the second class of stock rule because they're not part of the governing documents. So let's suppose you have an employment agreement where somebody's entitled to a certain amount of compensation. That may or may not be reasonable compensation, but that's the deal they made. That's their compensation. That's how they're going to treat it for tax purposes as well. I mean, the IRS might go back and try to recharacterize it down the road, but that's their deal. That is made through an employment agreement. The single class of stock rule is based on the corporate governing documents that govern the legal rights. The stock has equal rights to distributions. The Articles of Incorporation say that. These employment agreements are side deals. They don't affect the rights to the stock. They may have to do with rights relating to the business, but they do not affect your rights as a shareholder. So there's cases where there were taxpayers who were just taking horrible advantage, like the controlling shareholders took horrible advantage of the minority shareholders, and they took out extra benefits and stuff, and the minority shareholders couldn't even get distributions. They were having what we call a K1, KO. They were getting a K1 for their pro rata share of the S Corp earnings, but they weren't getting any cash to pay their taxes. And so those minority shareholders said, hey, we're not getting proportionate benefits. It's not an S Corp. And the tax court says, yes, it is. You have identical rights to distributions. If the majority shareholders are taking advantage of you, go and enforce your rights. Sue on your rights, enforce your rights. But you have those rights. So yes, you are still an S corporation. So that's because, again, the Articles of Incorporation state that what the rights to distributions are. Now, what happens if you have something in your operating agreement? The operating agreement says what your rights to distributions are. Those are your governing documents, just like your Articles of Incorporation are. Now, really, from a corporate law setting, your Articles of Incorporation are really more akin to your Articles of Organization and LLC, and your operating agreement more akin to bylaws and shareholders agreements. But really, the operating agreement is a little bit stronger than those shareholder agreements. It does have the rights are a lot more ingrained in this operating agreement and more defined by the operating agreement than you typically will see in your bylaws. And so if you do have something in your operating agreement that allows for disproportionate distributions, that's going to be just like having your Articles of Incorporation, or at least arguably. So when you think about the settings for second class of stock, if you have an employment agreement, the S Corp regulations say specifically employment agreements are not going to give rise to a second class of stock. But that's because they're side agreements. If they're part of the operating agreement, then they may be part of the governing document, and therefore they're not a side agreement. So, I don't know for sure how that will come out, but I think it's very, very risky. So, I would do side agreements for the compensation, I might say that the operating agreement will say, well, your side agreement is not a self-dealing thing. That's fine, but other than that, it would be really if you're going to want to be an S Corp, you need to be especially careful. You can have your compensation spelled out as a partnership. That's fine, but if you're going to be an S Corp, I would take that out of the operating agreement to the extent possible, because when in the operating agreement, they're not protected from the second class of stock argument. Letter rulings are frequently issued to correct operating agreements or partnership agreements that violate the second class of stock rules, but the IRS will not rule in advance whether your state law limited partnership violates those rules. this specifically in the IRS's review procedure dealing with issuing private letter rulings. It says that. And it's been that way for a number of years. Now, if you issue a profits interest in an LLC that's taxed as an S corp, that would violate the second class of the single class of stock rule. But you could try to get inadvertent termination relief, and the IRS has issued that. But if you do want to have some kind of a profits interest, of course, you can do that through a compensation agreement, or the S corp can drop its business down into an LLC and then issue a profits interest in the LLC to that key person. Okay, getting into estate planning issues unique to S corporations. And if you have a QSST, it taxes the beneficiary on the trust taxable income. And so for an S corporation, it's really beneficial that you can use the beneficiary's tax rates. If you're a partnership, then and the partnership doesn't distribute all of its taxable income out, then you can wind up having income tax at the trust income tax rates. And after $13,000 of taxable income, those get to be very high. So a QSST is definitely a benefit to having an S corp. And a QSST is a trust, is a special type of trust. Basically, its terms are similar to those of a marital deduction trust, and the beneficiary elects to be taxed as a deemed owner for income tax purposes. You also can sell the beneficiary of a trust of a QSST can also sell an S corp to the QSST, and that's not an income taxable event. There's a lot of nuances around that, and I'm not going to go through them here. I just wanted to let you know that that's available. It's definitely not the be all and end all. Okay, slide 48. So, Code Section 2036 cases cause partnerships to be disregarded for estate tax purposes. We discussed that a little bit earlier. That artificially increases the value included in the owner's estate unless the taxpayer proves that the entity was created for a legitimate and significant non-tax reason. And this can be very punitive. S corporation owners, however, can avoid this issue. If the S corp owner retains voting stock and gives away non-voting stock, the retention of that voting stock does not in any way taint the non-voting stock. That's black letter law. You can see I have a review ruling cited. There's also proposed regulations under 2036 that say the same thing. Now, what if you want to take advantage of this rule, this review ruling 8115, but you're an unincorporated entity and you made your S election? So you're an LLC, you made an S election. Do you get to take advantage of this rule? This is what I'm going to address now. So in the Pierre case, which is a gift tax case, the tax court said, hey, we are not going to follow the check the box regs for gift tax valuation purposes. And this is a direct quote from the case. The long-established federal gift tax valuation regime has to count the state law property rights inherent in the LLC. You cannot apply the gift tax, the check-the-box rules regs to say that you would disregard a single-member LLC. When you're going to give away an interest in a single-member LLC, you have to count the state law rights in the LLC. A gift of an interest in what was a single-member LLC is not considered to be a gift of the underlying assets for gift tax purposes. And on slide 50, Pierre pointed out that Chapter 14 has special rules for valuing business interests, and so if Congress knows how to apply special valuation rules for business interests, and Chapter 14 is how it spoke on that, and the check-the-box regs are not going to overturn it. Now, there was a case called Morawski where it approved for the non-tax reasons for forming a single-member LLC that is disregarded for income tax purposes, and that approval was helpful when there were gifts of the LLC interest made later. The Pierre case said it didn't find Morawski to be controlling because the IRS was not arguing the check-the-box regs. It was simply saying 2036 applied, and the tax court found a business purpose in Morawski. So, in light of this, I mean, I think that there's a good chance that you're not going to be able to use Revenue Ruling 8115 if you have an unincorporated entity. If you have an LLC or partnership that makes an S election, I would not rely on Revenue Ruling 8115. I'd want to have my legitimate significant non-tax reason. If you want to rely on that revenue ruling, then consider converting to a state law corporation or making the LLC a subsidiary of one. So here's the two transactions. Number one would be the corporate, the LLC's articles of organization. They are changed so that for state law purposes that LLC no longer exists, but instead it is morphed into a corporation. It's just a continuation of that LLC or a continuation of the partnership. And under corporate law, it's just a continuation of that prior entity. The other way would be you form an S corporation that has ownership that's identical to the LLC that's taxed as the S corp. And then you contribute the LLC to that corporation. So then what happens is that's called an F reorganization, and you can, if you look in that at the very bottom right of that slide, it says there's a parenthetical 2P3H. That's what's called an F reorganization, Code Section 368A1F. That says if you're doing a mere change in form, there's no tax consequence to it. So you contribute the LLC to the state law corporation. There's no income tax consequence. The LLC becomes wholly owned by the S corp. So what happens is the LLC's attributes as an S corp get transferred to the parent state law corporation that's taxed as an S corp. So there's a continuation for income tax purposes. It's deemed to be the same S corp as it was before. Instead, it's in corporate form instead of unincorporated form. But it's the same S corp for all tax purposes. And then the LLC itself becomes a disregarded entity because a single member LLC for income tax purposes is disregarded from its owners. So this allows you to just keep the LLC intact, keep doing business the way you were doing before, but the state law S corp is the one that files the return, and the single member LLC is simply disregarded for income tax purposes. So that would be what you might want to consider doing if you have an unincorporated entity and you want to avoid this Powell problem. Next topic on slide 54, if you have a closed sale business, so it's illiquid and you have a problem paying your state tax, so you can go ahead and do what's called a Code Section 6166 election that allows you to pay interest only for 4 years and then 10 years of principal and income. And, I'm sorry, principal and interest. You don't have to prove hardship or anything. You just have to prove what portion of your estate was this qualified closely held business. Now, if you have a tiered structure, then Code Section 6166 might consider the parent to be a mere holding company, and then its subsidiaries are the business. And depending on the situation, it may say, well, your holding company is just an investment entity. It's not a business, so we're not going to give you the estate tax deferral. So there's sometimes that tier structures can qualify and sometimes they don't. As an S Corp, though, the regulations for qualified Chapter S subsidiaries say those are disregarded. Those are disregarded not under the check the box regs, but under particular statute, under the S Corp rules. And that statute says, unless the regs provide otherwise, for all federal tax purposes, we are going to disregard the Q sub as a separate entity. So the subsidiary is disregarded as an entity. The parent is deemed to directly do everything the Q sub does. So it says, unless regs say otherwise, the parent is deemed to directly own the assets and run the business. The regulations do have a number of things that they carve out and say that we are going to count the Q sub as a separate entity. But 6166 is not in there. So I do think that you would be able to disregard your Q sub as a separate entity for purposes of 6166. But if you have a single member LLC as your subsidiary, it's not a Q sub. It's not under those rules. It's under the check the box rules. So I do like having single member LLC subsidiaries for reasons relating to S qualification that are a little bit beyond the scope of this course. But there is a disadvantage for 6166 that it could be that the Q sub is considered to be a tiered structure. That the disregarded LLC would be considered to be a tiered structure, whereas the Q sub would not. So there's kind of a pro and con to that. Okay, 555 in the charitable area. If you have unrelated business taxable income, your K1 items are per se unrelated business taxable income, and so is a gain on the sale. In certain cases, it may be helpful to have a liquidation as of the date of death. And if you have an unincorporated entity being your S Corp, then you have 75 days after death to go back and liquidate as of immediately after death. And I'm not going to go into those details now because I'm running out of time, but the article goes over that and the materials go over it. Recent developments, disproportionate distributions. The taxpayer represented that they created a second class of stock and got inadvertent termination relief. I think that was probably an overreaction to assure a buyer. I would not consider that. I would not have said that creates a second class of stock. In this case, the taxpayer asked the IRS to say that, so the IRS said, "Well, I'll go along with you." Okay, here's my last slide. I have a whole bunch of resources there that I list. I want to go through some questions here. Somebody was asking about DeMarco. How would you analyze a situation where the employer says, take it or leave it? I will employ you for $100 a year, and I'll also pay an annuity to your spouse and kids. But if they didn't give you that, you would have gotten $150 salary. Well, again, if they didn't give you the choice, we are saying that there's a property right here to the annuity. So I would be concerned that there may be a gift tax consequence. And in this case, the idea was $100 cash plus an annuity worth $50 a year. I think that's a pretty material annuity. I'd be concerned about whether that would be more akin to the split dollar regime. Okay, so I'm almost out of time here. Again, I encourage people to subscribe to my newsletter if they haven't yet. Reports on Hectorling. Hectorling is starting up next week, and the ABA Real Property Trust and Estate Law section has reporters who send summaries on those. They report on the sessions, and I get those summaries and I comment on those summaries. So anybody who would like to get the ABA RIPD summaries as well as my comments on the summaries, You're welcome to subscribe to my Heckerling newsletter. And again, that will start in earnest next week. I look forward to seeing you on July 27th for my second quarter newsletter. At the very bottom is a link to other resources that Thompson Coburn offers. So I encourage people to click on that and subscribe to anything you're interested in. Thank you for participating in our webinar. Please complete and submit the survey that will display at the conclusion of the webinar. Again, look forward to further contact with you and talk to you next quarter. Thank you.